Hi, welcome to Let's Talk Bonds, the bond market podcast on INR Bonds. I'm Arjun Patsarthi. And in this podcast, we're going to talk about the outlook for Government of India bonds. Whether the Government of India bond yield curve, I will define yield curve in a short while, can move down, steepen, or do both. That is a big question, and investors should understand where they can make maximum returns depending on the answers to this question. Right? So, what is the Government of India bond yield curve? The government yield curve is the plotting of different yields and maturities of a single bond, a single segment, like a Government of India bond, a GSEC, where if you see the yields across the maturities of GSECs, the 5 year yield is at around 6.74%, the 10 year around 6.83%, the 15 year around 6.89%, and even the 40 year is just around 6.99%. So if you look at the spreads between the 5 and 40 year, it's only about 25 basis points. Now the question is, if the outlook for G6 is positive, then should investors invest in the 5 year, 10 year, 15 year, or 40 year GSEC to make the maximum returns? And where is the most risk as well? Now, all this depends on how the whole yield curve can move. Can it move up? Can it move down? Can it steepen? Can it stay flat? So that depending on the answers to the question, the portfolio managers will position their portfolios accordingly, and investors too, or financial advisors can advise the clients to invest in this part of the yield curve for Government of India bonds to maximize their risk return profile. So just before we go into the outlook of the direction of the GSEC yield curve, uh, investors must remember that bonds carry risk, price risk, and Government of India bonds carry interest rate risk, which is price risk. They don't carry credit risk. Um, Corporate bonds, on the other hand, carry both price risk and credit risk, which is credit risk is the risk of default as well, where investors can lose capital if the issuer doesn't pay up. But Government of India bonds do not carry credit risk because of the fact that they're issued by the Government of India, and the Government of India can always print money to pay back investors. Now let's get back to the direction of the future outlook of the direction of the yield curves. Now, so given that the GSEC yield curve, like I said, it's currently flat at this point of time, where the difference between the 5 and 40 year is just around 25 basis points. Now, if investors are investing in GSECs and say they invest in the 40-year GSEC or 30-year GSEC or the 15-year GSEC or the 10-year GSEC, now what they would be expecting is that the whole yield curve, that is the 5, 10, 15, and 30, leave out the 5 also at this point of time, the 10, 15, and 30-year GSEC yields will start to move down from here. And if they move down from here, the prices will rise and investors can make capital gains and they make extra returns from G6. So that is the bet they are making on. Now, the 5 year, if even if it's doesn't move down, but if it stays at say 670 and the 10, 15, and 30 year moves down below the 5 year, then what it means is that the GSEC curve is getting inverted, which again means that at some point of time RBI will cut rates. But the question is whether this curve will invert, where the 5, 10, 15, and 30 goes down below the 5 year, or will the whole yield curve, with this a 5, 10, 15, and 30 shift downwards from here, where even if you keep the spreads at 25 basis points, say the whole yield curve moves down by 25 basis points. That means the investor will make more money by investing in the 10, 15, and 30-year bonds than investing in the 5 year bonds. The other outlook is that can the yield curve steepen? That is, if the RBI, now looking at the US Fed, Now, while the RBI has said that they are not going to look at the US Fed while forming their own monetary policy, if they look at the US Fed and which who has indicated that they're going to start cutting rates either by the end of this year and the next year, and a series of rate cuts next year. And also the moment in the US Treasuries, where the 10-year US Treasury, which was trading at higher levels than the 2-year Treasury, is now, which was trading at lower levels in the 2-year Treasury, is now trading at higher levels in the 2-year Treasury. So in the US, what has happened is that the yield curve has steepened, has shifted down and steepened. So the 10-year US Treasury yield, which was at around 480, and the 2-year US Treasury yield, which was over 5%, has now come down. The 10-year has come down to 380 levels, and the 2-year Treasury has come down to 3.2% levels. So clearly, this is a case where the whole yield curve has shifted down and also steepened. So technically, investors have made money by investing both in the 2-year, 5-year, and 10-year G-Secs and the 30-year GSEC and the 30-year US Treasury, because one is it has steepened, so the whole curve has shifted down, and so the 2-year yields have moved on much higher than the 10-year yields, and even the 10-year yields have moved down, and so they have made and the prices of all these treasuries have increased. So investors have made money in all the investments across the curve. In India, if you look at the GSEC, supposing investor invests in the 5-year GSEC and say there is a chance that the RBI can cut rates to 6%, the repo rate, which is at 6.5% now, and the 5-year GSEC yields moves down to 6.25%, which is a 50 basis points move, while that 15, 10, 15, and 30-year moves down by just 25 basis points. Now, technically, the money the investor could make in the 5-year GSEC would be almost equal to the money they are making in the 10, 15, and 30-year GSEC. Maybe slightly higher in the 30-year GSEC they can make. But the idea is that while taking a lower risk in the 5-year GSEC, and because it's moved down much faster, the prices have increased much fast, the yields have dropped much faster than the 10, 15, and 30-year GSEC. The investors um, increased his return with a lower level of risk. The question is whether this is the phenomenon that can occur going forward. This is well a possibility where the GSEC yield curve can steepen even as it shifts down. So investors will make money across the curve, but there could potentially the returns could be much higher in the 5-year with a lower level of risk. So it depends on each investor's risk appetite whether the yield curve can move down. Now, the question is, will this happen? Will this shift downwards to the steepening happen? Now let's see what are the factors that can drive it. If you look at the swap curve, which is the interest rate swap OIS curve, the 5-year swap is below 6%, while the 1-year is at 6.4%. So clearly, the 5-year OIS is talking about lower rates going forward, while the 1-year rate is at 6.4%, largely because of the fact that RBI is still maintaining the repo rate at 6.5%. So 5-year swap is saying RBI is going to cut rates going forward, and we don't know at what point of time. Now, that is one market indication, but other factors are also pointing to a better, more positive factors going for government bonds. Clearly, one is globally the outlook is clearly towards softer interest rates, and yields are coming down across. The second is that Indian inflation too is like below 4% levels, though there could be base effect. RBI has projected over 4% for this year, but it's not very far over the 4%. And so clearly they are in a much more comfortable position. The third factor is that we have had the oil prices globally are down. So the core inflation, which is the headline inflation, which includes oil and food, now can potentially stay at lower levels because of lower oil prices. Now, with lower oil prices, our trade deficit, our current account deficit, are looking in a much better position. And with and inflation technically can stay down. The monsoons have been good across the country, and with a bit of weakness that is showing globally and in the domestic market as well, with signs of slowdown in a few sectors, including automobiles and other sectors. This could mean that a demand-led inflation may not be forthcoming. So all this points to a positive shift in the government of India outlook for interest rates and the outlook for GSEC yields going forward. The other indication is also the fact that with GSEX being included in the uh, global bond indices, we are seeing good amount of inflows into bonds. So around $15 billion of inflows have come into government bonds in this calendar year, and which has been negative in the last few years. So, which is a clear positive sign that there is attractiveness at the at global investors for Indian bonds. And also, this is also corroborated by the fact that the Indian rupee has been pretty stable at around the 83 rupees to the dollar for more than a year now, well over a year. So, which is again with lower oil prices, better trade, current account deficit, and all this pointing and higher portfolio inflows points to a points to have higher balance of payments, and foreign exchange reserves at pretty high, good levels, at record high levels, holding on there. Um, this is so. This again points to the fact that a stable rupee with high reserves, low current account deficit, increases the attractiveness of government bonds, Indian rupee bonds to global investors. So this is all the positives. So which could mean that the yield curve can shift, GSEC yield curve can shift down and steepen as well, because the moment the yield curve shifts down and steepens, it indicates that this can be a lot. If it stays there for a couple of more years, then this could mean that um, uh, the economy can again regain on its get back on its higher growth path going forward. This is the typical scenario. But if the belief is that the slowdown can be really big and the RBI needs to cut rates very sharply, then there could be a case where the whole yield curve shifts down much faster from here, and technically you could see much better returns at the longer end of the yield curve. The latter case at this point of time is not seen apparent in the factors that are presented to us at this point of time. So the base case for a positive side investors and can look at is that the yield curve can steepen and shift down, but not by a very, very high margin. Um, so clearly, risk averse investors can look at investing in the shorter end of the G sector, which is a 5 year, while more risk heavy investors can look at the 10-year plus G-Secs to get more returns, especially on the capital gains side. On the risk side of this, can the G-Sec yields move up when the whole yield curve shift up from here? Or again, there could be a case where there could be a case of steepening where the longer term yields move very sharply from here, while the short term yields stay stable. Now, what can drive this phenomenon? This phenomenon can happen when a couple of things. One is that there's a global slowdown. There's a trend towards capital moving to safety, and when capital moves to safety, then there could be currency market volatility. Foreign investors could sell Indian bonds and Indian assets. There could be rupee depreciation sharply, which could lead to higher inflation expectations. And all this can point to uh, 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 a case where the government can increase its borrowing to support growth in the economy. If there is then seen to be a very heavy, a very sharp slowdown in the economic growth because of global issues. So if all this tends to happen, then there could be a case where there is levels of G6 could where G6 could rise, and investors could, if they sell from buying at lower yields and then sell it at higher yields, and they're doing it in the long G6, they can see capital gains, capital loss. But having said that, if they just hold on to G6, they will get the capital back. So the second phenomenon where the yield curve steepens, but with the yield curve not shifting down, but the longer ends moving up. At this point of time, again, the factors are not suggesting that is a scenario, but investors would have to keep a watch on that particular scenario to make and balance out their kind of the outlook they have on the JSEC and where they take positions accordingly. So it really depends on investors looking at each of the factors before taking a investment in government bonds. Obviously, if they just want to hold it to maturity, there is no issues. But then if an investor is looking at buying a 10-year to 15-year bond and exiting after 1 to 2 years, they would need to balance out the risk and return factors, positives and negatives, as mentioned here in this podcast earlier, and take their positions accordingly. Thank you very much for listening in, and do follow us on all podcast channels of like stock bonds. This is Arjun Patsati signing off.